Yes, it's now ready in YouTube as well. So we have so far 25 participants, close to 230 signups for today's session. The maximum capacity is 100. So others, they should be able to catch up from YouTube. Thanks for reserving this valuable time for your self-improvement, okay? For your skill development. I can assure you that you will learn significant things in this next 60 to 90 minutes. Before we even start, I request you to have a notepad and pen alongside because you will see many key things are being discussed, many life-changing things as a banker, as a finance executive, or as a professional. So I want you to make note of them. So have a notepad and pen alongside, and also have a glass or bottle of water. Okay, if you have notepad with you, just type NP. Just type NP if you have notepad. And now and then I'll be asking some questions like this, basically to ensure that we are connected. Sometimes or in few occasions my connectivity gets disrupted, so I want to make it clear in the beginning itself. So for some or the other reason, if during the course of discussion, if internet connectivity is lost, I would request you to stay back for next 3 to 5 minutes. In the meantime, I can make some other alternate arrangements. Okay, yeah, I could see Aditya is ready with notepad and pen. Jagan, Jigesh, Bhavna, Damodran, thank you. Lingaya, Prasanna Agarwal, thanks a lot. And keep participating. Okay. Whenever I ask question, just take that 2 seconds to answer. That ensures that, or that also gives me an assurance that yes, you are deriving value, you are learning from this session. Okay, fine. Now the time is 9:03. We'll just wait for 2 more minutes. We'll get started. We'll get started by 9:05. Okay. And if any of you are working in bank, just mention the name of your bank. And if possible, just mention the name of the city or town from where you are attending this. So we'll use this 2 minutes for that introduction purpose. Okay. If any of you are attending from outside India, please do mention that. Yeah, Subhash is from Bangalore. Welcome, Subhash. Jigesh from Early Salary. Yes, Jigesh, I noticed your site and I think you have enrolled in one of our courses. Madhav from Nepal. Anupam from Axis Bank. Good. I used to be an empanel trainer for Axis Bank, Anupam. Prasanna from Ranchi, Jharkhand. And Bhavani from Nepal. Manoj Acharya, again from Nepal. Anupam from Lucknow. Sultan from Bangladesh. Good. We have 1 more minute. Yeah, Bhavna, attend this session. And at the end of the session, I'll share my WhatsApp number. Get in touch with me. I'll share what are the professional courses you can pursue for career advancement in banking sector. Okay. Yeah. Hanuman Sai from Andhra Pradesh. Srinivas, employed with ICICI Bank. Welcome. And this session will range between 60 to 90 minutes. And I would request you to ensure that you stay till the end. I can assure you each and every minute you spend on this webinar will be a value add-on. Otherwise, I could not have repeated this particular topic for more than 50 times now. Okay. I could say several thousands of bank executives have attended this webinar in the past 6 to 7 months. So you will also get that benefit. So thank you very much. It's 9:05. We'll get started. As far as the presentation part is concerned, I have pre-recorded it fully. I do not want to miss out on anything. It's fully pre-recorded, but I'll be traveling with you along throughout the session and we'll have interactions. Okay. Shall we start? Just type start. Just type start so that we can get started. Sorry. Yeah. Thank you. I'm switching off my cam now. Hi all, thanks for joining this webinar. Whoever attending this in Zoom, whoever attending in YouTube, thanks for your time. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N. Raja, Chartered Accountant by qualification and a teacher by passion. So just a day before completing my Chartered Accountancy, I had the opportunity of being placed in India's largest commercial bank. I joined SBI as credit analyst, worked as credit analyst for 1 year, then got elevated as team leader, credit processing cell, worked on 250 plus projects, 5,000 crore plus size, then came out and started my CA practice, had practice for 7.5 years with focus on project funding, debt arrangement, debt syndication. Parallelly, I pursued my passion is teaching. So I started teaching financial management, strategic financial management for students in and around here in Ernakulam, Kerala. Then I explored, or I should say I leveraged technology. Thanks to technology, today I could teach several thousands of students. As on the date of recording, it's 180,000 plus students all over the world. That's the opportunity technology gave me, and that's why we are also interacting now. On the personal note, I am father of 2 children, happily settled in God's own country, Kerala.
Let's get started with today's presentation, Financial Analysis Must Skill for Every Banking Executive.
Before I get into the presentation, I just want to get your confirmation whether audio, video, was everything clear. Shall we start? Just type yes. Just type yes. Yeah. Thank you. Thank you.
As a bank executive, why you have to understand financial analysis? Remember one thing, what is the core business of banking? The core business is lending, and how bank takes that decision? They take that lending decision by carrying out something known as credit analysis, and in that financial analysis plays a very significant role. So if you want to rise up in your organizational hierarchy in bank, you should know what is the core business of banking, and you should be in a position to take that decision as well. So for that, you have to understand the elements, the factors related to that, and in that financial analysis is very important. Financial analysis of whom? Financial analysis of borrowers, because when they come to the bank approach for a loan, the bank should be in a position to evaluate the customer, then take a decision, and they can do that partly by carrying out financial analysis. And when I say financial analysis, it is analyzing their financial statements, the audited or the past financials, and also their estimated projected financials. And for carrying out that analysis, we are going to use 3 critical tools. One is financial ratio analysis, 2 is cash flow analysis, and 3 is fund flow analysis. Let's get started with financial ratio analysis. I'm going to take you through an example. Let's say there is company A and company B. Company A has reported a profit of 10 crore and company B has reported a profit of 5 crore. If I ask you which company had performed well at this point, what will be your answer? Most of you would say company A, right? Because company A has reported a profit of 10 crore. But if I supply you one piece of information, that is the sales achieved by this company, company A has achieved a sales of 100 crore and company B has achieved a sales of 25 crore. And if I ask you once again, Which company has performed well now? What will be your answer? There will be a drastic shift, right? Because earlier most of you would have favored company A, but now majority of you will be favoring company B. What happened? When you looked at the standalone figure, it was deceiving because profit of 10 crore looked better than profit of 5 crore. Yes, that's true. But when you gone deeper by comparing the profit with sales, you were able to calculate the profit margin. Company A has reported a profit of 10 crore on 100 crore. It means they have a profit margin of 10%. Whereas company B has reported a profit of 5 crore on 25 crore. It means they have profit margin of 20%. So what's happening? Company B has performed well. In this case, what we have done is we have compared the profit with sales and we have calculated this ratio. Profit by sales into 100. That is what we have calculated as profitability or profit margin. Okay. So ratios are basically a relationship between two numbers which are created in a logical way. Yes, we related sales and profits, and it's a relationship between two numbers, and there was a logic in relating the sales and profit because we can measure profitability. We related current assets and current liability to numbers, and the logic is it helps us to understand the liquidity. Okay, so ratios are relationship between two numbers which are created in a logical way, and it will help us to understand the past, present and future performance, and it will also help us to understand the strengths and weaknesses of businesses. Yes, by looking at the ratio we were able to understand that in which year whether they were stronger in the past or in the present. Current ratio example. And by looking at the profitability ratio we were able to understand like which company is performing well. So we have understood the strength and weakness. So like that we can give many variations. Okay, so that's about ratios, and we are going to understand the ratios by looking at its classifications. Ratios are broadly classified into four categories. They are liquidity ratios, capital structure or leverage ratios, activity ratios and profitability ratios. First, let's get started with liquidity ratios. Already I explained what is liquidity. Liquidity is basically ability of the business to meet its short-term expenses, short-term obligations without difficulty. At this point, I just want to bring the balance sheet here. So those who don't know what is balance sheet is a simple statement which will show from where and all money had come for business and where and all that money had been used. Okay, so for business money can come from owners, we call it as equity. Money can come from outsiders, we call it as liabilities. When money comes from outsiders, it can come with an obligation to pay within 1 year or pay after 1 year. If it comes with an obligation to pay within 1 year, we call them as short-term liabilities because we have to pay within 1 year. And using these money, which are basically raised as repayable within 1 year, which we call them as short-term liability, we can use this liability money to create asset, that is short-term asset. But if you look at this, the short-term assets are greater than short-term liability. How it is possible? Because the short-term what is raised in yellow box is smaller, but short-term assets are larger. It means this short-term assets could not have been created without the support of some long-term funds, because only a portion of short-term assets are funded by short-term liabilities. It means there got to be some remaining funds which have been used in creating short-term assets, and that's how it should be for every business. Short-term assets should be greater than short-term liabilities, because short-term liabilities are those liabilities which you have to repay within 1 year, and for repaying that you need resources. Resources will be in the form of short-term assets, so the resources should always be greater than the obligation. That's why I've captured the short-term assets as larger size and short-term liabilities as smaller size. That's how it should be for an ideal business. Okay, right. Now, to understand this liquidity concept, Let's first digest this fund utilization principle. Whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you are raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft. And when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house. You are constructing something else which I don't want to mention. because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here what happened is I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year, and for paying them I don't have short-term assets, because the existing short-term assets is only 70 million. For that there is a corresponding obligation of 70 million, whereas for the remaining obligation of 30 million I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time, and those lenders will not wait till I settle my long-term assets or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose. Okay, right. With this understanding, let's get into liquidity ratios. Liquidity ratios are broadly classified into 4 ratios, and in this webinar we are going to focus on the first one. That's very important, that is current ratio.
Before we move further, how many of you got the essence of fund utilization principle? Already I have sensitized you how important it is in the beginning itself, right? This can be a lifesaver for several thousands of business, several thousands of banks customers. If you have really got the juice of it, if you have understood what was the message that is conveyed, then you have to take a responsibility now. The responsibility is you have to teach this to others. You have to spread this message to as many as possible. We have to make this as a movement. This is what I was doing for the past 6 to 9 months. I teach this and I ask my students, I ask bank executives, finance executives, entrepreneurs to teach this to your fellow colleagues, friends, entrepreneurs, so that they can safeguard their business. It's a lifesaver. So whoever understood this, if you have really understood and if you're ready to teach this to others, just type IWT. IWT stands for I will teach. It means I'm passing this to you. It's now your responsibility. Okay. So in this session, if at all I say a key takeaway for you means it's this fund utilization principle. This is not only applicable for businessmen, it is applicable for each and every one of us. This is what going to instill a kind of a financial discipline in our financial decisions. Okay, so please spread this message, make this as a movement. Do not divert short-term funds for long-term purposes. Okay, yeah, thank you. I could see pouring I will teach messages. Thanks a lot. Let's continue.
So current ratio scenario should look like this, because we know how to calculate current ratio, which is current asset by current liability. Okay, but current ratio scenario should be like this, that is current assets should be greater than current liabilities, and we calculate the current ratio like this, current asset by current liability. If current assets are greater than current liability, it means the resources are greater than obligations. Okay, let me take you through 3 scenarios. Look at the scenario 1 where the current liabilities are given. Okay, so this is total current liability, which is 300, and the resources that are available to settle that obligation is available. Okay, so the obligation is 300, resources are 600. So I think here the liquidity position is really comfortable. If I plot this in a form of a graph, the red bar indicates the resources, blue bar is the obligation, and here you can see there is a comfort zone. We call that as positive net working capital. How I have calculated? I've compared the current assets with current liabilities. So there are excess current assets. Excess current assets means that portion of current asset is not created by current liability, but they are rather funded by long-term funds. The portion of long-term funds used for creating current asset, we technically call it as net working capital. So if a business is having positive net working capital, it is a good sign, because to that extent that business will not have liquidity pressure. Okay, here they have 600 million as current assets and 300 million is the current liability. So they have pressure only for 300 million. For the remaining 300 million, they don't have pressure because it can be settled over a period of long time. Okay, that's what we understand when current ratio is like this, like 2:1. Let me give you another scenario. Here the current liabilities is same and current assets, there is a difference. Okay, look what's happening. Current liabilities are 300 and current assets were also 300. So you have an obligation of 300 million. For that you have resources of 300 million. It looks like a perfect scenario, but that's not the case. Okay, because let's say the bank CC has become due. This 100 had become due, and you can settle that using your cash and bank balances. Then when this 200 becomes due, what are the assets you have? Only the stock and receivables. Let's say the receivables are getting converted into cash. That's good. So out of 200 you settle 100, but still you have another 100 pending. So what will you do? How will you manage? Because you cannot settle your suppliers with the stock. You purchase stock from them. You cannot pay them in stock. You have to pay them in cash, and you cannot tell them please come and take back my stock. If you say so, then that becomes end of the credit business for you. You will not get credit from any suppliers in future, because that supplier will take care of the task of negative marketing for you. Okay, so that's why I said this scenario, even though it looks like an ideal scenario, it is not ideal. It's not an ideal scenario, because some of the current assets will not come for rescue when you want them very desperately. Okay, let me take you through scenario 3. And here the current liabilities are same, whereas current assets are comparatively lesser. Look at your current liabilities, it is 300. Look at your current assets, it is 200. So here you can see the problem. You have to settle 300 million within a period of 1 year, and for settling that you have resources of only 200 million with you. You have to settle 300 million, but you have only 200 million. So how will you manage that 100 million? That's the question. Okay, that indicates this business is going to land in trouble, number one. Number two, this will also communicate their financial discipline. They've raised 300 million short-term funds. They should have created short-term assets of 300 million, but what they have created is only 200 million. So the question is, what happened to that remaining 100 million? It's very obvious they have diverted it for long-term purpose, and they have committed that sin or blunder of diverting the short-term funds for long-term purpose, which will put that business into serious trouble. Okay, so if I put that in a form of a graph, look, the blue bar is the obligation and red bar are the resources, and clearly you can see there is a shortage, and to that extent this business is in a danger zone, because here the resources are lesser than the obligations. So when your current assets are lesser than the current liability, that is current asset minus current liability, obviously your net working capital will be negative. You will have negative net working capital. Okay, so let's capture all the 3 scenarios here. Scenario 1, current asset 600, current liability 300, so the net working capital was 600 minus 300, 300. Net working capital means the long-term funds which were used for creating current assets. So here if you see 300 long-term funds and 300 short-term funds put together, current assets of 600 was created. And if I look at the current ratio, it is 300 by 600, it is 2:1. In scenario 2, there is no long-term fund contribution at all and the ratio is 1:1. And in scenario 3, 200 is the current asset, 300 is the current liability. It means there is a negative net working capital. Negative net working capital indicates a diversion of short-term funds for long-term purpose. So whenever you come across a negative net working capital, it means there is a diversion of short-term funds for long-term purpose. And whenever there is a diversion of short-term funds for long-term purpose, the current ratio will also be below 1. Here 200 current asset divided by current liability 300. 200 by 300, you are going to get the current ratio as 0.67:1. It means for every 1 rupee obligation, they have resources of only 67 paise, which clearly shows there is a shortage. Okay, and this also means that there is a diversion of fund. At this point, I want to ask you a question. Since some of you or most of you are working in bank, what is the minimum current ratio insisted by your bank? What is the minimum current ratio insisted by your bank? Shall I take a couple of minutes to explain the logic behind a minimum current ratio of 1.33? Why banks are insisting on minimum current ratio of 1.33? Shall I explain? Okay. Let's say I have current assets of 100 million and current liabilities of 75 million. And with this information, if I calculate the current ratio, it will be current assets by current liability and it is 100 by 75. So it is 1.33. 100 by 75 and it is 1.33. So what I can infer is when my current ratio is 1.33, it means 75% of the current assets are funded by current liabilities. And what is even more important is the remaining 25% of the current assets, that is current asset minus current liability, the remaining 25% of the current assets are funded by long-term funds. Funded by long-term funds, we technically call them as net working capital. So when the current ratio is 1.33, we can safely conclude that 25% of the current assets are funded by long-term funds. It means there is a 25% long-term fund contribution for creating current assets, and that's what most of the banks stipulate as margin for working capital. For example, if you go and check the sanction letter issued by most of the banks, they would have stipulated 25% margin for working capital credit facilities. Even if you look at the Tandon Committee recommendation for arriving at working capital, they said that 25% of the current assets have to be funded by margin, and it is only the remaining 75% banks can explore funding. Okay, it means there should be a 25% contribution of long-term funds for creating current assets, and that is verified or that is checked through current ratio. If current ratio is 1.33, then there is 25% contribution. If it is greater than 1.33, then there is greater than 25% contribution, and if it is less than 1.33, then there is less than 25% contribution. And that's the reason most of the banks insist on current ratio of 1.33. Okay.
So how many of you got the rationale behind 1.33? It's not a big thing. It's not a rocket science. But if you are exposed to this for the first time, or if you have really understood this, just type bulb on. Bulb on moment means, yes, you were exposed to this earlier, but you didn't know the logic or you didn't know the rationale, but it just got unfolded now. Yeah, thank you, Tejashwini. Thank you, Jagan. Thank you, Shah. Thank you, Bhavna. Thanks a lot. Just type bulb on. It means you are appreciating your learning process. When you appreciate the learning process, you will remember it, you will recollect it easily. Thank you very much. Thanks a lot. Let's continue.
Now let's move on to capital structure ratios. Under that, there are three ratios, but here we are going to discuss about what is important from bankers' point of view, that is debt to equity ratio. In debt to equity ratio, what we'll be doing is we'll be comparing the debt with equity to understand the long-term solvency of a business. Let me take you through a balance sheet. I'm just going to show you the left-hand side, that is the equity and liability side. Look at this, shareholder funds are 100, bank loan is 100, debentures are 100, and sundry creditors are 200 million. It means this business has raised 500 million from 4 different parties. Owners 100 million, from bankers 100 million, from debenture holders by issuing debentures 100 million, and from suppliers, sundry creditors 200 million. Now what we have to do, what we are trying to understand, it is debt equity ratio. So we have to compare the debt with equity. Equity is the owner's money. In this case, it is this 100. And debt is the sum of all the three. We call them as outside liabilities, and it is 400. So let's compare the debt with equity. Debt is 400. Equity is 100, and the formula for debt equity ratio is debt divided by equity, 400 by 100. We get the value as 4. Let me take you through a scenario, a 3-case scenario, so that we can understand it better. The first scenario what we are discussing now is total outside liabilities of 400, equity, the money contributed by the owners, as well as the profits that are attributable to them put together, we call it as equity, 100. So if I calculate the debt equity, that is total outside liabilities divided by equity, 400 by 100, I get the value as 1, and we express it as 4:1. It means for every 1 rupee contributed by the owner, this business has borrowed 4 rupees. For every 1 rupee contributed by the owner, this business has borrowed 4 rupees. So what we can understand, if this business is raising 5 rupees, 4 out of 5 rupees is by outsiders and 1 out of 5 is contributed by the owners. That's what you see here. Outsiders share are 4 out of 5, that is 80%, and owners share are 1 out of 5, that is 20%. So what's happening here? In this business, owner's stake is very less, whereas outsiders have contributed more, and I see this as highly risky proposition. Because this 80% of the funds which had come into the business would not have come free. They would have come with a cost, and these costs have to be met, let whatever be the situations surrounding the business or affecting the business, because they are all fixed cost. Look at this, in this case 400 million they have raised as debt, and they have to pay interest, they have to pay principal, let whatever be the market condition. Only in rare exceptional circumstances the regulators will step in and give direction to the banking system to not to demand for payment for some time, like what we have COVID. Reserve Bank came and said give them moratorium for 3 months, then give moratorium for another 3 months. Okay, but it will not happen every year. It happens only in rare situations. So in this case, this 400 million, they have an obligation, and that has a fixed cost in the form of interest, in the form of loan principal repayment, and they have to be met. And if for some or the other reason, if their sales comes down, and if they are not in a position to meet that commitment, meet that obligation, this business will get affected to the core. Because whoever have given money, they'll not wait for long. They go for legal recourses, and that could come as a big blow for the normal operations of this business. Okay, so that's why I say 4:1 is a highly risky scenario. Let me give you a second scenario where the outside liabilities are 333 and equity is 167. I chose these numbers to convey an important message. Because look, the total funds are 500. Here also it is 500 only, but I've chosen a different proportion. The proportion works like this. If you take the debt 333 and if you divide it by equity of 167, you get the debt equity ratio as 2. We express it as 2:1. It means for every 1 rupee contributed by the owners, this business is borrowing 2 rupees. It means if this business is raising 3 rupees, 2 out of 3, that is 2/3, that is 67% is coming from outsiders, and 1 out of 3, that is 33% is coming from owners. And for me, this is much better than scenario 1. In scenario 1, outsiders contribution are 80%, where in scenario 2 it is only 67%. To that extent, there will be reduction in fixed cost as well. In scenario 1, owners have contributed only 20%. In scenario 2, owners are contributing 33%. I see that as a good sign because owners will be investing more of their money when they see their business is more promising. Let me take you through scenario 3, where total outside liabilities are 250 and equity is 250. Again, I have maintained the total as 500, but I have changed the proportion. So what is the debt equity ratio now? 250 by 250, it is 1:1. It means if this business is raising 2 rupees, 1 out of 2, that is 50% share is coming from outsiders, and 1 out of 2, 50% share is coming from owners. And this is much better than the first and the second scenario, because here the outsiders share have come down, and as a result the fixed cost related to that will also come down. Fixed commitment, fixed obligation will come down. This will reduce the burden, it will reduce the pressure on the business. And owners are investing 50%. It means they know this business is very much promising. That's why they are committing their money. So what is an indication? The indication is scenario 1 attracts high financial risk. Scenario 2 we say ideal, and scenario 3 is the best. Okay, so this ratio, that is debt equity ratio, or we call it as TOL, total outside liability, by T&W, that's basically the equity. Okay, that communicates the long-term solvency. Businesses with a high risk, businesses with high level of ratio will have a high financial risk, and because of that, it's possible that during recessionary market conditions, those businesses may not be able to withstand, they'll get washed away. Because when their sales comes down and if their fixed cost is going to remain fixed only, it means the impact is reduced sale, higher fixed cost, so the profit will turn out to be loss, and that business will have its natural death. Okay, so that's what we are trying to understand through this debt equity ratio. So whoever working in bank, you will know, because you will be carrying out credit rating of the customers, and in my experience, the highest weightage is given for the single ratio, that is debt equity, or we call it as total outside liability by tangible net worth. Let's move on to the next very important topic, that is working capital holding levels. As a banker, this is very critical for you, because when you sanction working capital credit facilities like cash credit, you have to understand what is the working capital holding levels, because that only influences the working capital credit facilities. Okay, let's get started. This working capital holding levels can be subclassified into inventory holding period, debtors collection period, and creditors payment period. I'll take you through one by one. The first one is inventory holding period. I'll take you through two scenarios, scenario 1 and 2. In scenario 1, I'm giving you information about cost of sales. Cost of sales is 120 million. So please note, here I'm not giving you the sales information, rather what I'm giving you is cost of sales. So this excludes profit. Okay. Now, when they achieved a cost of sales of 120 million, they are maintaining an average inventory of 10 million. So how to look at this? In one full year, they have sold goods, and for that the cost what they have incurred is 120 million, and on an average always they maintain an inventory of 10 million. This is scenario 1. Scenario 2 also, cost of sales is same 120 million, but average inventory what they maintain is 60 million. Okay, now let's see. We have annual cost of sales. Now I can easily find out monthly cost of sales by taking the annual cost of sales divided by 12. So 120 by 10 will give me monthly cost of sales, which is 10 million in scenario 1, and scenario 2 also it is 10 million only, because my cost of sales is 120 million. Now I have two critical information. One is monthly cost of sale. I also have information about average inventory. Look at the scenario 1. The average inventory maintained is 10 million and monthly cost of sales is also 10 million. So I can say the average inventory maintained is equal to 1 month cost of sale. Whereas if you look at scenario 2, average inventory is 60 million whereas monthly cost of sales is 10 million. So I can say the average inventory is 6 times of monthly cost of sales. How I derived this? I derived inventory holding period. I just took average inventory, I divided it by monthly cost of sale. In scenario 1, 10 million by 10 million gave me the value as 1. It means this business is maintaining inventory equivalent to 1 month cost of sale. Whereas in scenario 2, they are maintaining inventory of 60 million divided by 10 million. It means they are maintaining inventory equivalent to 6 months cost of sale. So this will communicate a lot to the bankers. Because when a customer is maintaining inventory only for a period of 1 month, their profitability will be more because they are not locking their money in inventory because they keep less of inventory, but they were able to achieve sales. It means there is a kind of rotation happening, turnover is happening. Whereas if you look at scenario 2, they are maintaining inventory for 6 months. It means they are going to have several other costs, and because of that their profitability will be less. It means they have to spend on storage cost. There is a possibility that goods will get damaged. They have to spend on finance cost because their money is locked for 6 months in godown. They have to find alternate money. They come to bank itself for a loan, and that comes with a finance cost which will have impact on the profitability. On the other side, instead of bank money, if they are putting their own money, there is an opportunity cost because that money could have been invested elsewhere, which could have got them even a better return because now it is just coming to fund what is locked in the godown. Okay, so these kind of impacts can be assessed by looking at the inventory holding period. So when the inventory holding period is less, that business will have more profitability, and when inventory holding period is more, when it is beyond the industry benchmarks, when it is beyond the past levels, that will have impact on the profitability. Okay, next we'll move on to debtors collection period. I'm going to take you through a similar scenario 1 and 2, and here what I'm giving you is annual credit sales. In scenario 1, annual credit sales is 120 million and average debtors is 10 million. In scenario 2, it is 120 million, but their average debtors is 40 million. Okay. Now we know annual credit sale, so let us find out monthly credit sale, which is nothing but annual credit sale divided by 12 months. 120 by 12, it is 10 and 10 in both scenarios. Now you just compare this average debtors with monthly credit sale. Monthly credit sales is 10 million and debtors is also 10 million. So we can say debtors is equal to 1 month sale. But in scenario 2, debtors is 40 million whereas monthly credit sales is only 10 million. So we can say the debtors is 4 times of monthly credit sale. So we can express that as debtors collection period, which is nothing but the average debtors divided by monthly credit sale. In scenario 1, it is 10 by 10. It means this business is taking 1 month to collect money from its customers. Whereas in scenario 2, it is 40 divided by 10. It means this business is taking 4 months to collect money from its customers. So here we get the message. The message is in scenario 1, the collection is happening at a faster pace. Whereas in scenario 2, it's slower because they're taking 4 months to get their money back. And what will be the impact? This slow collection will have impact like liquidity strain because your money is locked with the customer. So you have to manage your show by borrowing from bank or elsewhere. So that comes with a finance cost and which will have impact on the profitability. And when you give it on credit, especially for a longer period, or when the customers are taking longer period to pay you, there is a possibility that they may end up not paying also. So bad debt losses. And when you bring in your own money to manage because of this funds getting locked here, there is an opportunity cost. Okay, so this is debtors collection period. In the same way, we can also interpret creditors payment period. Let me put all the numbers here because it's very similar to the debtors collection period what we have discussed. Okay, look at here. Scenario 1, The monthly credit purchases is 10 million. Average creditors is also 10 million. So we were able to conclude that they are taking 1 month to make payment to the creditors. Whereas in scenario 2, they are taking 4 months to make payment to the creditors. So what that means, it basically communicates the payment speed. In scenario 1, the payment is happening at a faster pace. It's good for the business. In scenario 2, the payment is happening at a slower pace. Here, the decision that payment is happening at a slower pace should be arrived only by comparing with the credit period what is offered by the creditors. If the creditor themselves are giving 4 months credit period, then that is not an issue. But if the creditors are giving only 1 month period, and if this business is taking 4 months to settle the creditors, then that indicates various other things. Because slow payment could mean that this business is not having enough money to make payment to the creditors. It means they are having liquidity strain. And when the payment period is getting extended, there will be high finance costs because the suppliers will load penal charges. And when creditors are not paid on time, then the creditors can even go for a legal recovery action. So it could also indicate potential future problems. Okay, so these kind of inferences are possible by looking at the working capital holding periods, basically the inventory holding period, debtors collection period, and creditors payment period. Next, we'll move on to coverage ratio. In that, first I'm going to explain debt service coverage ratio. We call it as Dscr. This ratio is calculated to measure the repayment capacity of a borrower when he approaches a bank for a term loan. So how repayment capacity is measured? It is measured by finding out the cash profit available for debt service and comparing that with the repayment obligation for every year, which is interest plus principal. So here, how this cash profit available for debt service is computed. Let me show. What we do is we take profit after tax and dividend. With that, depreciation will be added back. Reason being, depreciation is a non-cash item. Not even a single penny cash goes out in the name of depreciation. Okay, since we want to find out cash profit, what we do, we add back depreciation, because while arriving at the profit after tax, this depreciation was subtracted as an expense, but no cash goes out, so we are adding back depreciation. Then we are also adding interest, not because it is a non-cash item, but because we want to know what is the cash profit available for paying interest and principal. If you want to know what is the cash profit available for paying interest and principal, you cannot take cash profit which is after paying interest. Okay, because we are starting with profit after tax and dividend, right? This profit after tax was arrived after subtracting all expenses, which also include interest. So let us add back that so that it gets nullified. So by doing this, taking profit after tax and dividend, and by adding depreciation and interest, we arrive at cash profit, and this is the formula followed by most of the bankers. Let me take you through an example so that you can understand it better. Look at the statement. This particular business has made a sales of 1000. Their direct cost is 500. Their gross profit is 500. Operating expenses are 100. Depreciation is 100. Interest on loan is 100. So from sales, direct cost was deducted 500. They had a gross profit of 500, and we are deducting 3 expenses. So from gross profit, when we deduct all the 3 expenses, we get the profit before tax. So 500 minus 300, you have as 200. From that, let's deduct tax at 50%, which is 100. So you get profit after tax of 100. Now listen. For computing debt service coverage ratio, what we have to do? We have to take profit after tax. With that, we have to add back depreciation and interest on loan. In this case, there is no dividend, so we are starting with profit after tax. So 100 plus 100 plus 100, 300. This becomes the cash profit. This cash profit have to be compared with the repayment obligation, which is basically interest on loan of 100, what we have seen, plus interest on principal I am giving you, which is 100. So what is the total obligation? 200. What is the cash profit? 300. Now we can find out debt service coverage ratio. DSCR is equal to profit after tax and dividend plus interest on term loan plus depreciation divided by interest plus principal. In this case, it is 300 divided by 200, and you get as 1.5 times. You get the value as what? 1.5 times. And what does that communicate? For every 1 rupee loan obligation, which is interest plus principal, this business is having a cash profit of 1 rupee 50 paise. So it looks good, right? Because for paying 1 rupee, they are having a cash profit of 1 rupee 50 paise. It means from 1 rupee 50 paise, 1 rupee can be paid off. Still 50 paise is available with that business. They can use that 50 paise for supporting their working capital requirements. Okay, right. Now I want to ask you a question. What is the minimum Dscr insisted by most of the banks? If you're working in a bank or if you are exposed to this concept, please give your answer. What is the minimum Dscr insisted by most of the banks? Okay. 1.1 will be insisted by the banks who are ready to take risk. Okay, because 1.1 is a very small ratio. If they are okay with that, it means they are willing to take more risk. It means the side effect is the interest rate will be very high. 1.5 is accepted by most of the bankers, and 1.75 is insisted by public sector banks, okay, who are very conservative. They'll be insisting a DSCR of 1.75. Now let me take couple of minutes to explain the DSCR rationale, why some banks are insisting on 1.75 times, or say for that matter even 1.5 times. Why banks are insisting on DSCR of 1.5 or 1.75 and not just 1? Because if DSCR is 1 for paying loan obligation of 1, they are having resources of 1, why not banks stop with that? Why they are insisting on 1.5 or 1.75? Shall I explain? Okay, let me explain the rationale behind this minimum DSCR. Look at this. If DSCR is 1.75 is to 1, it means for every 1 rupee obligation there is a cash profit of 1 rupee 75 paise. So from 1 rupee 75 paise, 1 rupee can be paid, and what is left with the business is this 75 paise. This 75 paise is the profit after tax, after dividend, after paying interest, and after paying principal also. So it basically goes as retained profit, and this retained profit will go to a head called reserves and surplus in balance sheet under the head equity. And equity along with other long-term liabilities will become long-term funds, and that long-term funds can be used for supporting working capital margin. If this does not make sense for you, worry not. Look at this. Your statement of profit and loss only communicates what is profit. From that we calculate cash profit. Then we compare that with the obligation and we arrive at DSCR. And if DSCR is 1.75, it means out of 1.75, 1 can be paid, 0.75 can be retained in the business. And I told you that this retained profit will go to balance sheet under the head reserves and surplus. So now this reserves and surplus along with capital will be called as equity, and this equity along with the long-term liabilities will be called as long-term funds. These long-term funds can be considered or can be used for creating long-term assets. I repeat, these long-term liabilities can be used for creating long-term assets. But if you look at the proportion, look, you have so much of long-term funds, but only a portion of long-term funds has been used for creating long-term assets. It means there is some surplus. So what's going to happen here? This business is also raising some short-term funds. It is creating short-term assets. The short-term assets are more than the short-term funds. How it was made possible? Because short-term funds are very small, but short-term assets are much bigger than that. It was made possible because the remaining surplus of long-term funds, the remaining surplus of long-term funds has been utilized for creating this short-term assets. Now try to link with our fund utilization principle. We said a portion of current asset should be funded by short-term funds and another portion should be funded by long-term funds, because I said I marked it as ideal. utilizing the long-term funds for creating short-term assets is ideal, because that is going to relieve the business from liquidity pressure. So if a business is having a Dscr of 1.75, that 0.75 gets retained in the business. It gets retained, it becomes part of long-term funds. So that long-term funds, after being utilized for creating long-term assets, there will be some surplus. That surplus will in turn get utilized for short-term assets, and this is what we call as long-term funds used for creating short-term assets. Technically, this is the net working capital. Okay, so it is not that mere profit along with capital, along with the long-term liability, they all become put together long-term funds, and they are actually supporting short-term asset creation. So this is the logic. I hope you would have understood. Next, there are general profitability ratios. Within that, you have 5 set of ratios where basically you will be comparing the profits with sales, and there are also return on investment ratios. There are also return on investment ratios where the profits will be compared with investments, capital employed, owner's money, but I'm not getting into these because we have some more minutes where we have to touch on the cash flow and fund flow. So I'll take your approval and get started with cash flow analysis. Here I need your participation. Look at this. There is a company which has made or achieved a sales of 100 crore by incurring expenses of 60 crore and reporting profit of 40 crores. So now I have a question for you. The question is, what is the cash generated by this business? Sales is 100, expenses are 60, profit is 40. So what is the cash generated by this business? The cash generation can be equal to profit when they have realized their entire sales of 100 crore and met their or paid their entire expenses of 60 crore. It means 100 crore had come in and 60 crore had gone out. So the profit will be equal to cash. But it can also be greater than 40 crore. It can also be less than 40 crore. It can be greater than 40 crore when you have realized the entire sales and you have paid only part of the expenses. So here you have cash as 70 crore. And it can be less than 40 crore when you have realized only the part of the sales and you have paid full expenses, okay, or most of the expenses. So you have realized only 70 crore but you have paid entire 60 crore. So here your cash is only 10 crore, okay. And this can also undergo a change. This cash of 70 crore can come below 40 crore. It can even come below, it can come below 70 crore. It can even come below 40 crore. And this cash of 10 crore can go above 10 crore. It can even go above 40 crore. How? Let's say a loan has been repaid 40 crore. Some machinery has been purchased for 20 crore. It means out of 70, 60 crore gone. So what is the cash position? It is now only 10 crore. And in the second scenario, let's say a debenture has been raised, money has come in for 30 crore. Some asset has been sold, 20 crore money had come in. Equity, money had come in from owners, 20 crore. So we have 70 crore money coming in. So now the total position is 80 crore. So what we have to understand is, in business, cash is not generated merely by profit. It is from various activities. We call them as cash flows from operating activity, cash flows from investment activity, and cash flows from financing activity. Look at this 70 crore. This is a cash flow from operations, operating activity. Whereas this 40 crore repaid is a result of financing activity. They raised finance in the past. They are repaying that now, financing activity. Look at this machinery purchase 20 crore. They are investing their money. It's an investment activity. Whereas this debenture of 30 crore money coming in is the result of financing activity. And they have sold assets 20 crore. They are disposing of their investments as a result of investment activity. Whereas this equity 20 crore which had come in is a result of financing activity. And finally, the 10 crore cash is a result of operating activity. So what we can infer is, in business, cash can come in and go out under 3 activities: operating activity, investment activity, and financing activity. So in a year, if you capture all this, cash flows from operating, investment, and financing activity, and if you total them, you get to know what is the cash generated during the year. And with this, if you add the opening cash and equivalents, automatically you will get the closing cash position, closing cash and cash equivalents position. And this is something known as abridged cash flow statement. So what's happening here? I'm capturing the cash flows from operating activity, investment activity, financing activity. I'm aggregating them so that I can get the cash generated during the year. And with this, when I add the opening cash balance, automatically I get the closing cash balance. Okay. So this statement, by having a look at this statement, I'll get to know from where money had come and where money had gone out. Okay. And it also acts as a reconciliation statement, because by adding the cash generated during the year with the opening balance, I get the closing balance. Let me show you a real life cash flow statement. It will look something like this with many line items and subline items. But being part of bank executive, being part of bank, your focus should be on how to read the cash flow statement, because the preparation of cash flow statements are taken care by accountants. So you should know where you have to keep your eyes. Okay, look at this cash flow from operating activity. It's a positive figure of 4,60,600. Look at this investment activity. It is a negative figure of 1,75,000. So the positive figure of 4,60,600 from operating activity means they've run their business for one full year, and from operations they've made a positive cash. Whereas investment activity negative figure means they have paid 1,75,000. Cash had gone out to the extent of 1,75,000 because they have made some investments. So some other assets have come in. So if you want to know what are those assets, you have to go back to the statement. Look, they have purchased plant and machinery. They have purchased some investments. Then look at the next key item, that is investment activity. Sorry, financing activity. The next key item is financing activity, and it is a negative cash of 2,70,000. It means to that extent cash had gone out. And if you want to know what are those components, you can go to the cash flow statement and you can see. And now if you add all the three, you get to know what is the cash generated during the year, and it's 15,600. So when I look at this, what I infer is they made 4,60,600 from their operations, and they use their own money for making some investments. And despite spending on investment, they had so much of money, so they are very easily settling their financial obligations. And despite all this, they still have positive cash of 15,600. And here we need not worry because they made so much of money, but everything has gone out. We need not worry because look at their opening cash and cash equivalent position. They already had 1,50,000. So this 1,50,000 plus what they've made during the year, if you add, still at the end of the year, their position is really comfortable. It's actually better than the previous year. Previous year it was 1,50,000, and at the end of the current year it is 1,65,600. So when I look at the cash flow statement, things are looking too good. But you should also be very cautious, because sometimes businesses will be showing good amount of profits, but cash flows from operating activity will be negative. It's because most of their sales are logged with the customers, or most of the money is logged in the inventories. So because of that, cash flows are not happening, so they'll be struggling. So for a healthy business, what is required is a positive cash flow from operating activity. Look at their investment activities. Is it positive or negative? Positive means they are disposing of their investments. They are getting some money out of investments. If they are disposing of their investments, if they are selling their investments, what assets are they selling? Are they selling the core assets or non-core assets? If they are selling the core assets, then the question of going concern will arise. Because by selling their core assets, how they will continue their operations in future? Or if they are selling their non-core assets, it's a good strategy, because they are infusing liquidity into the business by disposing of the assets which are not required for running the show. Look at their financing activity. If it is a positive figure, it means money had come into the business. From whom that money had come? Is it from owners? Is it from outsiders? What are the terms? All those can be explored and it can be understood. So these kind of critical information are possible by going through cash flow statement. Okay, and I'll take some more minutes, couple of minutes, not couple of minutes, some 3 to 5 minutes to explain fund flow analysis. I need your participation here. Look at this. There are 3 companies A, B, C, and you have information about their long-term sources and short-term sources, total sources. You have information about their long-term uses, short-term uses, and total uses. I want you to digest this information. I want you to digest this information. Spend some time. and then identify which company is in trouble here. Is it company A or company B or company C? Company A, they've raised long-term funds of 50. They've raised short-term funds of 50. So total of 100, of which 50 is used for long-term, 50 is used for short-term. Company B also raised in the same pattern, but of which 70 is used for long-term and 30 only used for short-term. And C raised in the same pattern, but of which 30 only used for long-term and 70 is used for short-term. So you have to tell me like which company is in trouble. Let's see the results. I'm going to rearrange this statement. Let me bring the long-term sources here and I'll compare that with long-term uses. So let's see what is the position. If you take company A, long-term sources and uses are same, so no surplus, no deficit. But company B, long-term source is 50, long-term use is 70, so there is a deficit of 20. And company C, long-term source is 50, long-term use is 30 only, so there is a surplus of 20. And now let me take short-term sources. I'll compare that with short-term uses and let's see what is the position. For company A, obviously no surplus, no deficit. But company B, they raised a short-term fund of 50 and used only 30, they had a surplus of 20. And company C, they raised only 50, they've used 70, they had a deficit. So it might look like company C is in trouble because they had deficit and company B is comfortable because they had surplus, but that's not the understanding. Understanding, pay attention here. Company B, they raised a long-term source of 50, but they created a long-term use of 70. How is that possible? With 50, you cannot create 70. So from where they got the remaining 20? Obvious, they got that remaining 20 from here. So this short-term surplus of 20 with the long-term source of 50, they got money worth 70 million, which they've used for long-term purpose. And because of this reason, we say company B is in trouble. Because company B, they raised a short-term source of 50 and their short-term resources are only 30. It means they are supposed to repay 50 million in 1 year. With that promise, they raised 50 million, but what they have done is they have created only 30 million worth of resources. They have simply diverted 20 million for long-term purpose. So within 1 year, they are supposed to repay 50 million, but they have resources only 30 million with them. So whoever have given that 20 million, they'll go for legal action against this company for not fulfilling the obligation, for not fulfilling the promise. For not fulfilling the promise. In this case, company B, they'll not be in a position to fulfill the promise because that 20 million they have invested in long-term asset. Long-term use. It can be land, building, plant and machinery, and you cannot sell them just like that. It will take more than a year, but they will not wait for more than a year. Okay, that's why we say company B is in trouble. But if you look at company C, they've raised 50 million long-term, they've spent only 30 million, they had a surplus of 20 million. And that surplus of 20 million along with short-term fund of 50 million, they've created short-term use of 70 million. And if you look at it from the other side, within 1 year they are supposed to pay 50 million, and for paying that 50 million, what are the resources they have? 70 million. That's why we say company C is in comfortable situation. Okay, right. So this statement which helped us to get more clarity is fund flow statement. Let me give you a real life fund flow statement. It will look something like this. Okay, it's basically part of it. Look, here you have the sources and here you have the applications. Sources we basically call as long-term sources. Application we call as long-term users, like what we have seen here. Okay, now look at this. Let me analyze this also so that you will get complete clarity about fund flow analysis. And here I'm not teaching you how to prepare fund flow statement, but I'm teaching you how to read the fund flow statement. Okay, look, in 2018-19 they had long-term sources from operations and by selling investment of 5,650, and these are all their long-term uses. They purchased plant and machinery, they paid taxes, they paid dividend. Okay, so 5,650 was the source, 6,200 was the use, there was a deficit of 550. Let's analyze this. So what is the total source? It is this 5,650. Okay, when they had 5,650, what they did, they first purchased plant and machinery. Okay, not first, they purchased. Okay, all right. Since they had so much of fund, okay, 3,700 is okay, because even after paying all this, they'll have a surplus of 1,950. And then what they are supposed to do, tax is compulsory, they cannot escape. Okay, from 1,950 they paid taxes of 1,100. So they are left with 1,950 minus 1,100, 850. Okay. When they are left with 850, they did this mistake. When they are left with the long-term fund of 850 only, what they did, they went and paid dividend of 1,400. What is the amount they have? 850. But what is the dividend they have paid? It is 1,400. How? It's not acceptable, right? But they did that. How? They went and paid 1,400. They faced a shortage of 550 and they have managed that shortage by using short-term funds. Okay, so here there is a deficit, and this deficit was managed because they took some short-term funds. A simple example can be a cash credit or overdraft, because they wanted to pay 1,400 to their owners, but they have only 850. So what they did, that 850 plus money available in cash credit or overdraft to the extent of 550 put together, they have paid dividend of 1,400. So this shows their financial discipline. When they have only 850, why they are paying 1,400? That's not right, right? I mean, this is not a wise approach. Or ideally what this business should have done, when they purchased plant and machinery of 3,700, here they should have raised some long-term funds. So some portion of this 3,700 could have been funded by long-term funds, and that would have left good amount of surplus so that they could have paid this dividend easily. Or the other way is, when they have an investment to take place like this to the extent of 3,700, why they are paying dividend? They could have used this money for funding that, right? They didn't do. They paid dividend when they don't have adequate funds. When they had only 850, they paid 1,400. They simply diverted short-term funds for long-term purpose. So this is what happened in 2018-19. In 2018-19, or ideally they could have done one thing. When they are left with the long-term funds of 850, they should have restricted their dividend to 850. In that case, there will not be any diversion of short-term funds for long-term purpose. But even it should not be like that, no, because there should be some long-term surplus contributing for working capital of the business. Here, instead of contributing, they have stolen the money from cash credit for paying as dividend to the owners. Okay, see how powerful the statement is. It is revealing what was hidden. Let's see what happened in 2019-20. In 2019-20, their funds from operations have improved significantly. They've also raised money by issuing debentures. So it is 7,800. And from that, they are purchasing plant and machinery. Okay, they have a lot of money, let them. It means after purchasing plant and machinery, they have surplus of 5,025. And they want to pay taxes. Okay, good, let them pay. So from 5,025 taxes paid, what is left over now? 3,325. From that they want to pay dividend. Okay, let them pay 2,250. It means the balance left over is 1,075. At this point they should have put a break, but what they did, they went and purchased an investment of 1,500 when they are left with the funds of only 1,075. It means this is the grave mistake which they should not have committed. 1,075 is the surplus, 1,500 investment, not in their business. They have purchased investments, some shares or stocks of some other company. By using whose money? By using some short-term money. Look, they have only 1,075, but how they spent 1,500? The 1,075 plus 425 gave them 1,500. They have invested in someone else's business. This business is not learning from its mistakes. When they are left with 1,075, they should have stopped at that level. They should have ensured that this money is going for supporting the working capital requirements of the business, but they didn't do. Okay, so these kind of all hidden practices will get caught, will get revealed in fund flow statement. In my 4-year of stint in State Bank of India, the statement for which I had high regards is the fund flow statement, because this is one master health checkup report which will reveal all the hidden problems of the borrower. I mean, if at all you will get awestruck, or if at all you will become unanswerable in one statement, means that is fund flow statement, because it is so clear. Okay, because it shows no, like from where they got money, where they have used. See, they have paid dividend in 1819 when they didn't have money. They've invested in someone else's business in 1920 when they did had money. So this all shows the intentions, the integrity of people behind the show as well, not just numbers. It also goes deeper into qualitative aspects. So that's the power of fund flow statement. So develop your skill in reading fund flow statement. Such a powerful statement. Okay, all right. So with this, I wish to conclude this presentation, and I believe most of you would have had a bulb on moment. So if you really had a bulb on moment, please type bulb on.
We have come to the end of this webinar. Thank you very much for spending your valuable time on the session, and I believe all of you would have derived value. If you had learned something useful, if you had that bulb on moment, if you derived value today, just type IDV. I wish to see how many of you have derived value. If you have really derived value from the session, if you feel this time spent is really useful, just type IDV. Thanks a lot. Thanks for all your support. And in the beginning of the webinar, I said I'm into online teaching space. I've published a series of courses for bankers. Can I have your permission to introduce our upcoming workshop on banking credit analysis and also the courses which I've published for bankers so that you can take your learning journey to the next level? If you are permitting me to introduce, just type I permit. Just type I permit. I'll take that as your approval. Then I'll introduce my workshop and courses. Thank you very much. Here we go. We are going to conduct an online workshop on banking credit analysis process. What it is all about, let's see. Are you struggling in understanding banking credit related matters like financial ratio analysis, cash flows, fund flows, then working capital assessment and products like cash credit, letter of credit, bank guarantee, term loan appraisal, covering concepts like debt equity analysis, Dscr, FOIR, and so on? Are you a bank executive, say like relationship manager or credit analyst or credit manager who have recently joined the bank or NBFC or who have been transferred to the credit department recently? Are you a finance professional working on project funding for your clients? Or are you a finance manager finding it hard to understand the expectation of your bankers? Then this workshop is for you. Welcome to online workshop on banking credit analysis process. It's going to be a 1 day live workshop. So what you will learn from this workshop: number one, financial analysis covering financial ratios, cash flows, and fund flows. Number two, working capital financing, covering the working capital concept, cycle, assessment, credit facilities. Then number three, fund-based and non-fund-based credit limits, covering letter of credit, bank guarantee. And number four, term loan appraisal, covering viability study, assessment, DSCR, FOIR, break-even analysis, and sensitivity analysis. And you have lot many takeaway from this workshop. Number one, you will get access to the workshop presentation material, which runs for 220 plus pages. But the beautiful part of this workshop is you are going to get lifetime access to 15 banking credit courses and lifetime access to 10 banking credit ebooks. Yes, by signing up for this workshop, you're not only going to attend the workshop, but you are going to get access to 15 courses, starting with financial ratio analysis mastery course, where the lifetime access price you can see on the screen. Then you will get access to how to prepare and analyze cash flow statement like a pro, how to prepare and analyze fund flow statement like a professional, then how to prepare CMA report for bank loans, how to read balance sheets. So far it is 5 courses. Then you will get access to how to carry out credit risk rating for non-trading entities, how to carry out financial analysis as a banker, how to carry out term loan appraisal and assessment as a banker. Then you can learn banking credit analysis through various case studies. Then you will also get access to how to read CIBIL report course. So 10 courses. Course number 11, you will get access to masterclass on working capital management. Here you will learn the concepts with examples and case studies. Then you will also get to learn working capital and term loan more from bankers' point of view. Then you will get access to a course called Finance for Non-Finance Executives. This will be a lifesaver if you are a banker from non-finance background. Then you will get access to a course called Basics of Forex Management, a complete study. This will help you to understand your export and import based customers. And finally, you will get access to a course called Collateral Securities, a complete study, where you will learn different types of collaterals and its various formalities. So totally 15 courses. And I also said you will get access to 10 ebooks. It's basically a combination of ebooks and crash course. So it's a crash course on certified credit professional, then crash course related to JAIB, CAIB. Then you will get ebook on financial ratio analysis, cash flow statement, DSCR, current ratio, debt equity ratio, fund flow statement, and you will also get one career guidance material where you will get to know what are the professional courses that a bank executive can pursue while working in a bank. So what all this? It's basically workshop, 8 hours workshop plus a package of courses and e-resources for bankers. It's basically 15 courses and a combination of crash courses and ebooks, 10 elements. Okay, so all this, if you look at it, they're all focused on banking credit. They're all banking credit topics. And here what you're going to get is 2000 plus video lectures, and you will get lifetime access for them. And there is also going to be a question answer support. Yes, once you sign up for this workshop, it's not going to end with that just 8 hours. No, whenever you come across questions or whenever you get some doubts or whenever you need clarifications, you can ask us. It means I am providing you a lifetime support by adding you into our community. We have a community in Telegram where all our paid students are added, and you can ask your questions. I'll be answering them. Other senior members, other senior bankers in the group will be answering, and there will be an overall question answer support for you throughout lifetime. That's why I highlighted lifetime. Okay, fine. So all this, how much it's going to cost you? If you ask me, if I total all this, the workshop price and lifetime access price of all the 15 courses and 10 resources, it would cost 30,984. But worry not, worry not. You are not going to pay 30,984. 50% of this works out to 15,492. But again, worry not. I'm not going to give you 50% discount. I want to give you more. So how much you have to pay to get access to this workshop and the 15 courses and 10 resources? It's just 2,999. It's 90% off I'm giving you. You have spent your valuable time in attending this webinar. It means you have that desire to learn. You have that need to learn in this competitive era. Only those who update themselves with the skills that are required for the job, only they can sustain, only they can grow. You have taken that first step. This workshop and this series of courses will take you to the next level. That's the assurance from my side. So if you have derived value from today's session so far, and if you believe this workshop and the set of courses and e-resources will help you to go to the next level, then here is an opportunity. You can sign up now. So it's workshop. This is going to be conducted on 23rd Jan 2021. It's fourth Saturday, banking holiday. Timing is from 9:30 a.m. to 5:30 p.m. I'm going to share the enrollment link in the chat section. Whoever watching it in YouTube, check the chat section or the description below. It's basically workshop plus 15 courses plus ebooks. Some of you may be very much interested in this program plus courses, but 23rd Jan, if it is not a feasible date for you, worry not. Worry not if you could not attend. Just register for this workshop. I'll be sharing the recordings of this workshop so that you can access them whenever you want. You can play back any number of times. That's the support from my side. Okay, so if you have derived value and if you want to take your learnings to the next level, if you want to really learn the basic skills that are required for the job you are into, this is an opportunity. Enroll now. It's going to be valid for very limited time because it's a 90% discounted coupon offer. It's going to be valid for next few minutes. I'll make it as valid for next 15 to 20 minutes. Do register and enroll now. Once again, the link is shared in the chat section, and whoever watching it in YouTube or Facebook, check the description for the link. It's basically for a workshop plus 15 courses plus ebooks. If any of you have already enrolled in the financial analysis package for bankers, if any of you have already enrolled, for them alone, there is an opportunity to attend this workshop for rupees 999. They can contact me via WhatsApp. My number is 77360 So thank you very much. So it's time for you to take your action. Results for action takers. Results for action takers. You have spent your valuable time. If you're sitting this late night, it means you have that desire to learn. You want to grow. You want to set your foundation strong. And this workshop and the series of courses, which are very carefully selected for banking and finance executives. They are basically cherry picked out of 100 plus courses for you, and it will help to improve your overall credit and financial analysis skill. The link has been shared, and whoever enrolls now, I'll be calling out their name. I'll be giving my live acknowledgement. I want to give that live acknowledgement and assurance. And the link is going to be valid for next 15 minutes. Okay. I said few minutes. I'll make it as 15 minutes. In this 15 minutes, you can enroll. Yeah. Coming to Anil, already enrolled for this, can attend the same on coming Saturday. Anil, did you enrolled for 23rd Jan workshop? If yes, then you can. And I'll be calling out each and every participant. Whoever enrolls now, I'll be calling out each and every participant's name. Okay? Yeah. Anil, which course you have enrolled for? Whether you have enrolled for our earlier workshop, 8 hours workshop, if you had already attended, then it's going to be same. Otherwise, you can register for this. And if you have enrolled in any of the bundle courses, okay, you have already attended the earlier workshop. Okay, if you want to attend as a repeater, just send me a message in WhatsApp. I'll include. Okay, if you have already paid for the workshop, our earlier session, and if you want to repeat that, please drop me a message in WhatsApp. Okay, the link is valid for 15 minutes, and you are in a best position. You are in a best position to do the evaluation and take a better decision. It's because you have spent your valuable time. Okay, and we have our first participant. Let me take you through. Yeah, here we go. I'll take you through a website. Let me see whether my notifications are enabled. So ideally here I should be getting, yes, here I could see Neela Rushdie just purchased 1-day live workshop on banking credit analysis process plus courses. Thank you, Neela. Welcome to our community. This is an acknowledgement and this is an assurance from my side that this is one of your finest investment. You will learn the best of best on 23rd, and all the courses are structured and designed to help you to improve your credit and financial analysis skill. Thanks a lot for, taking action. Thanks a lot. Thanks a lot for demonstrating. Thanks a lot, and a warm welcome to the community. You'll be receiving a message in WhatsApp, which will have a link to our Telegram group. It's a community where you can ask all your questions, and answers will come from my side as well as from other participants. So thank you very much. Let's see who else. And whoever signs up, I'll be getting a notification here. Let me also have my mail opened. See, you are better positioned now to take a decision. It's not that you are going to commit your money on something which is absolutely remote or unknown. You have spent your time now, right? You have spent more than 60 minutes. You have listened to one of my key session, which was attended by several thousands of bank executives, and many executives have attended the workshop after attending this webinar, and it actually helped them to improve their skill. I just share the feedback of earlier participants. So this is the workshop, and this is the link which you would have got. Okay, and here you can see what is the feedback we have. We had participants from various scale, people working as credit managers, relationship managers, branch managers, from banking sector and from non-banking sector. We had management trainees, we had managers, we had head of finance and accounts department, manager accounts, and yes, all had an amazing learning experience. I've just cherry picked a few of the reviews and included in the course landing page. Okay, you can just go through that and take your decision as well. But it will be a day packed with tons and tons of learning for you. It can be an 8-hour session, but what you will carry from that will be lifelong. It will improve your overall, I can say, the dimension, how you are looking at things in credit and finance. You will get a makeover. You will be able to look at things in a very uh, perfect or in a distinct way. That's the assurance from my side. Okay, so I have shared the link. Whoever interested in enrolling, make use of it. Prabhudas, okay, Prabhudas is asking, Prabhudas is a banking premium member. Is it required to enroll further? Prabhudas, if you wish to attend the workshop, okay, because workshop is a separate element, you need not enroll the bundle. Okay, so I'm just answering Prabhudas. You need not enroll the bundle. You just drop me a message in WhatsApp. I will give you a link for a workshop alone. Okay, that will cost you 999. You can enroll. It's a 8 hours workshop. We have next set of participants. Let's see who is that. I'll be getting a notification here. Yeah, let me just refresh this. Or if I'm not getting that, I should go over here. Here we go. This is from R Prabhu. R Prabhu. Okay, no, it's for a different course. I'm sorry. It's for a different course. Did I missed anyone? Yeah, Jancy. I'm sorry, I missed you, Jancy. Jancy Agnes. This is to acknowledge. This is to acknowledge that I've received your payment. Looking forward on 23rd Jan. Thanks for the trust and welcome to our community. Right now, you can access all those 15 courses and 10 e-resources. Of course, workshop will meet live on 23rd Jan. Yeah. My WhatsApp number is 77360 22001. Okay. Ajay not accepting the payment from MX. Ajay, are you from India or outside India? India. Okay. If you have Google Pay or Phone Pay, you can give a try. Do you have Google Pay or Phone Pay? No. Okay. I'll give you an alternate link. I'll give you an alternate link. Just try with that. Okay. It's our InstaMojo payment gateway. If you're facing difficulty with the link I have shared, yeah, this is the InstaMojo. This is the InstaMojo payment gateway. If you click on this link, you will see the payment gateway page like this. Here you have to give the purpose as workshop and amount as 2,999. Go ahead with the payment. Okay, this is outside the normal process. So I have to give you a manual access. Okay, is that okay, Ajay? Yeah. In the meantime, we have our next participant. Yes, Kishore, yes, you can access. That's what I said. If you could not attend a day-long seminar, absolutely no issue. You register for the workshop. You will be getting the recordings. You will get access to all the 15 courses, 10 years, everything. Okay, so go ahead and register. Yeah, we have our next participant. Participant coming from, yeah, that's by Chokkalingaraja. Chokkalingaraja, I think we interacted sometime before. Just correct me because I could see you are from Dubai. Thank you very much. Yeah, Raja, thanks a lot. Thank you. So thank you very much for your trust, committing your hard-earned money on our courses. It's going to be your finest investment. And yes, you will derive lots and lots of value. See you on 23rd Jan and welcome to our community. And Kishore, yes, you can go ahead with the payment. I'll call out your name. I'll give my acknowledgement and assurance. Assurance is, again, it will be one of your finest investment. Okay, because I've put in years of energy in creating this. I've taken all my best efforts to make it as simple as possible. And that's the reason several thousands of bank executives have enrolled in these courses, have enrolled our workshops. Yeah, now coming to Mohammed. Uh, okay. Mohammed is from Bangladesh. Yeah, already you are in Telegram group. Okay, you need WhatsApp link. You want to know how to make payment. Okay. So for those who are attending from outside India, I'm going to share a link. Just have a look at this. Whoever attending from outside India, I'll share a separate payment option. Okay, I'm giving this answer in response to query raised by Mohammed. Mohammed, look, this is the payment option for students from outside India. You have online payment through Razorpay payment gateway. You have online payment through InstaMojo, PayPal, and direct bank-to-bank transfer. Okay, so these are all outside the normal process. So after the payment, you have to drop me a message in WhatsApp. So I'm giving my WhatsApp link here as well. Okay, this is my WhatsApp link. Yes, even credit card is accepted. Credit card is accepted in Razorpay as well as InstaMojo. Okay, yeah. In the meantime, we have another student. I believe that's from Kishore. Yes, Kishore, thank you very much. This is to acknowledge that I've received your payment. Thanks for your trust. Thanks for investing your hard-earned money on our courses. Even though you may not be attending this workshop, you have taken that step to invest your money on the workshop and the courses, and of course you will get access to the recordings. And all of you whoever have enrolled, You have taken your first step. I see all of you as an action taker. And if you want to get the real juice of it, real benefit of these workshop, these courses, okay, workshop will keep it later. If you want to get the real benefit of these courses and e-resources included in this bundle, please reserve 30 to 45 minutes every day. Okay, please reserve. It can be early morning hours or late evening or timing, something like this. Okay, just reposition yourself or go back to your school days. Like, please do this meticulously. Okay, make or do this continuously for a period of 11 to 15 days. Then it will become your habit, because what you do for continuously for more than 10 days, it tends to become your habit. So if you practice this for next 10 to 15 days, then over a period of 3 to 4 months, you'll be able to complete all the courses and you can access them in number of times because you're getting lifetime access. But remember one thing, lifetime access is a curse if you're not going to complete the first cycle within 3 to 4 months. If you're not going to complete all the courses within 3 to 4 months, then take it from me, you will not complete at any point of time. Okay, so please put a time schedule for yourself. Try to complete them within 3 to 4 months. Then do the revisionary cycles. Okay. Yeah, here we go. Yeah, thank you, Kishore. Wow, great. Thanks a lot. Okay, Ajay is saying paid via Amex. Let me just check, Ajay. Yeah, Bal Subramaniam, I also received your message. Just a moment. Yeah, I'm checking Ajay's message. Okay. Yes, Ajay, this is to confirm I've received your payment. I'll just put it on screen here. And for Ajay, I have to give a manual access. Yeah. Okay, I'm sorry. That's by Sharanya. Sharanya, I'll come back to you, Sharanya. Yeah, this is by Ajay. Ajay, thank you. This is to acknowledge that, yes, I have received your payment. Thank you very much for committing your hard-earned money in this workshop on our courses. And I'm going to give you access, but for that, I request you to create your student account in our portal. So just have a look at the screen. I'm going to share some details where you have to create a student account. Do you have a student account in our portal, CA Raja classes? You have. Okay. Can you just give me your email ID, or not required? I'll take it from your payment. I'm going to give you access now live on screen. Yeah. Sharanya, just give me 2 minutes. I'll complete the formalities for Ajay. Yes, here we go. Okay, Ajay, I'm going to put you into this course now. Yes, here we go. So Ajay, have a look on the screen. I'm assigning 1 day live workshop on banking credit analysis process plus 15 courses plus 10 resources to you now, lifetime. Yes, it's being added and it's added now. A warm welcome to our community and thank you very much for the trust. Thanks a lot, Ajay. Jancy, you need the link? No, not required, because you already have created a student account in our portal. So you just have to go to my courses and access the content. That's it. Okay. Yeah, we have our next student. Okay, that's by TKS, I believe. Yes, TK Sharanya. Thank you very much, Sharanya. Thanks for the trust. This is an acknowledgement from my side that yes, I've received your payment and you are going to get lifetime access to 15 courses plus 10 resources as well as workshop on 23rd Jan. Thank you very much for the trust and this is an assurance from my side that you have made one of the finest investment and thank you for being an action taker. In this dynamic world, when things are changing, when the change has become permanent, we have to keep our foundation strong. Okay, if we are strong in terms of foundation, that whatever be the changes in the outside environment will be able to stand strong. Of course, there will be some head changes here and there, but if our foots are strong, we'll be able to manage anything. And all of you are taking that step. That's how I look at it. Thank you very much. And anyone in the process of enrollment, and are you facing any trouble or any difficulty, let me know. Because I said this link will be valid for 15 minutes and we are close to 15 minutes now. Okay, if any of you are in the process of enrolling and if you want me to wait for a few more minutes, let me know. Otherwise, yes, it's time for us to wind up now. And whoever have enrolled, you will be getting an acknowledge message as well from my side that will have instructions as to how you can access the courses, and it will also have a link to our telegram group where you can join and get all your queries answered. Okay, right. So thank you. I wish to thank each and every student who have attended this, who have enrolled for workshop, and whoever interested in getting certificate for this workshop, you will be getting a mail tomorrow where you have to fill the form for claiming your certificate. And that will ask for a particular code. In that you have to give the code as FA. Okay, you have to give the code as FA 190120. FA 190120. This is going to be the code, and only if you key in this code, you will be able to submit the form. And whoever have filled this code, they'll be getting certificate for having attended this webinar. And of course, for that 8 hours workshop, you will be getting a certificate of participation. And on 23rd, it's going to be between 9:30 to 5:30. And I request all of you to spread this message. Please share about this workshop with your friends, with your colleagues who are interested in learning more about banking credit analysis process. Because yes, of course, they'll be getting internal training, but many times, having seen the banking training process at the closer level, what I understand is many times the training comes at a later point. Okay, in very few cases it is so perfect where the candidate is given training then he is put on to the job, but in many of the cases candidate will be put on the job maybe after 6 months or sometimes even after 1 year they'll be getting a training because it becomes a centralized setup, so it takes a lot of time. But credit is not an area to learn things by making a mistake, because mistake becomes very costly in credit. Okay, so certain fundas, very very critical fundas, everything will get addressed in this workshop, and that's why I'm requesting you, please share this workshop link with your friends and colleagues so that they can also join. And I can tell very confidently, very boldly that I have priced it at the most, because when I say 90% off, I mean it, it is 90% off. Okay, so please share with them as well. And thanks a lot, whoever staying back, uh, Jansi, Ajay, Bhavani, Kishore, Mohammed, Neela, Prabhudas, Rabin, Raja, TKS. Yes, I could see all of you or most of you have signed up for the workshop as well. So thank you very much. Thanks for the trust, and we'll catch up on 23rd Jan. Okay, is that fine? Shall we wind up now? And did I missed anyone? Anyone enrolled but I didn't call out your name, something like that? Yeah, Kishore, you'll be getting a WhatsApp message. Okay, you'll be getting a WhatsApp message. From that, you can directly enroll in Telegram group. Okay. Fine. Okay. So we'll wind up for the day. We'll catch up on 23rd Jan. Thank you all and a good night. Just type GN and you can leave. Thank you.